Welcome to Illuminati Silver. We tell the truth about silver. Today is Thursday the 30th of January 2020. And yesterday we published a video entitled FOMC leaves rates unchanged, gold and silver rise slightly, where we gave a very brief summary based on the Fed's FOMC decision not to lower interest rates, so that the Fed funds rate remains at 1.5 to 1.75%. And we've placed a link to this video in the description box below. We promised in that video to give a more in-depth analysis today, which we shall do. But for interest, before we do that, let's compare some of the data prices from then, when we published the video last night at 2100 hours, to today, or this afternoon, at 1600 hours GMT. The Dow was up just 12 points yesterday at 28,735 and currently stands at 28,616. So that's down 119. The S&P was up 2 points at 3279 and currently stands at 3258. That's down 21. And the Nasdaq was up 5 points at 9,275 and currently stands at 9,230, down 45 points. The dollar index was marginally up at 98.09 and currently is marginally down at 97.9. Gold was 1577 and is currently 1581. And silver was 1756 and is currently 1794, a very healthy gain achieved this afternoon. So let's now take a look at what happened yesterday and the takeaways that we have from the FOMC decision to leave the Fed funds rate unchanged. Now, much of the relevant information was in fact published by Bloomberg late yesterday evening. So let's take a quick look at their article. Fed holds main rate as Powell stresses need to hit 2% inflation. By Craig Torres, January 29th, 2020, 7 p.m. GMT, updated at 10:01 p.m. GMT. Article published in Bloomberg. The Federal Reserve kept its key interest rate unchanged and continued to signal policy would stay on hold for the time being, while stressing the importance of lifting inflation to officials' target. The central bank also made a technical adjustment to the rate it pays on reserve balances and said it would extend at least through April, a program aimed at smoothing volatility in money markets. Quote, "We believe monetary policy is well positioned to serve the American people by supporting continued economic growth," unquote. Chairman Jerome Powell told a press conference on Wednesday in Washington. Officials kept the target range of the benchmark federal funds rate at 1.5 to 1.75% and called that stance, quote, "appropriate to support sustained expansion of economic activity," unquote. U.S. stocks erased gains while yields on the 10-year Treasury note declined and the dollar fluctuated. Traders extended bets the Fed would cut rates towards the end of the year. Quote, "The Fed has made it clear that the barriers to move in either direction are quite high," unquote, said Daniel Ahn, the chief U.S. economist at BNP Paribas. Quote, "But we believe the wall for a cut is lower than the wall for a hike," unquote. He detected a dovish tilt in Powell's efforts to stress the Fed was uncomfortable with inflation running persistently too low. You may have noticed that we mentioned that in yesterday's video. Policymakers changed their statement to say that the current stance of monetary policy is appropriate to support inflation returning to the committee's symmetric 2% objective. Previously, they had said policy was supporting inflation near the goal. Powell explained in his press conference that the change was made to send a clearer signal that the committee was not comfortable with inflation running persistently below target. Quote, "We wanted to underscore our commitment to 2% not being a ceiling," unquote, he said. Their preferred gauge of price pressures, the Personal Consumption Expenditures Price Index, rose 1.5%, for the 12 months ending in November. Powell said inflation was expected to move closer to 2% over the next few months, thanks to so-called base effects, as unusually low readings from the early 2019 drop out of the calculations. Officials made some changes even while keeping their benchmark interest rate steady. They approved a 5 basis point increase on the rate they pay on excess reserves to 1.6%, a technical adjustment designed to keep the main funds rate within its designated range. The Fed raised its overnight reverse repurchase rate by the same amount to 1.5% and extended term and overnight repos at least through April. The central bank had earlier signaled such measures were possible. It downgraded its assessment of household spending to say it has been rising at a moderate pace, instead of its earlier characterization of the rate being strong. The committee repeated that economic activity has been rising at a moderate rate with strong labour market conditions. Officials gathered with financial markets on edge as a deadly virus in China weighs on its economy and could threaten global growth. Policymakers also endured another attack from President Donald Trump, facing re-election in November, who reiterated in a tweet Tuesday his latest call for the Fed to cut rates. The FOMC decision was the panel's second straight unanimous vote. Now that is important to bear in mind. Following 3 cuts in 2019, US central bankers have said their policy is supporting the country's record expansion despite headwinds from trade and geopolitical uncertainty. The implicit message is that while policymakers are alert to international developments, such as coronavirus, geopolitics, etc., the accommodative setting of policy, 75 basis points to 100 basis points, below the committee's median estimate of neutral, should give the economy enough support to endure modest changes to the risk landscape. Non-farm payroll growth averaged 176,000 a month last year, while the unemployment rate held below 4% for most of the year. Data since the December FOMC meeting have shown the housing market has held up, fueled in part by last year's rates cut. Consumers also remain upbeat about their prospects, surveys have shown. Manufacturing, however, has showed scant improvement, consistent with a downshift in investment and sluggish markets for exports. Business investment could be further dented by Boeing's suspension of 737 MAX production starting in January. The plane maker received just 3 commercial aircraft orders in December, down from 63 the prior month, and doesn't expect regulators to clear the grounded MAX to resume flying until mid-2020. End of article. Now, to support this article further, but perhaps explained in a more simple way, let's take a look at a Reuters article also published yesterday. There is some repetition, we admit, but it's worth bearing with us on this. Reuters article dated January 29, 2020, updated 15 hours ago. Fed keeps rates steady to tailor Treasury bill purchases later this year. The Federal Reserve held interest rates steady on Wednesday at its first policy meeting of the year, with the head of the US Central Bank pointing to continued moderate economic growth and a strong job market, and giving no sign of any imminent changes in borrowing costs. Quote, "We believe the current stance of monetary policy is appropriate to support sustained economic growth, a strong labour market and inflation returning to our symmetric 2% objective," unquote, Fed Chair Jerome Powell said at a news conference following the central bank's unanimous decision to maintain the key overnight lending rate in a range of between 1.5% and 1.75%. He noted signs that global economic growth was stabilising and diminishing uncertainties around trade policy, concern about both of which were key factors in the Fed's decision to cut rates 3 times last year. But he added, quote, "Uncertainties about the outlook remain, including those posed by the new coronavirus," unquote. The outbreak of the new flu-like virus in China has led to fears of a further slowdown in the world's second largest economy. After ticking off a list of positive developments, including the initial trade agreement reached recently by the United States and China, and some indication a slip in global manufacturing has hit bottom, Powell noted China's economy would see at least a short-term hit from the coronavirus outbreak. "We are very carefully monitoring the situation," Powell told reporters, adding that while the implications of the outbreak for China's output are clear, it is too early to determine its global effect or impact on the US economic outlook. The Fed's statement calling out solid job gains and low unemployment was little changed from the one issued after its December meeting. Quote, "The Fed's going to remain on hold for the foreseeable future, as long as GDP growth and inflation doesn't move outside of the bands that we're stuck in, anchored right around 2%, unquote, said Chris Gaffney, president of world markets at TIAA Bank. The Fed statement did not announce any immediate changes to the central bank's current practice of buying $60 billion per month of US Treasury bills to ensure adequate short-term liquidity in bank funding markets. But Powell said the Fed would likely begin scaling back that amount sometime in the April to June period, when the amount of reserves in the banking system would likely be deemed adequate. After that, purchases would be made, and the Fed's balance sheet expanded as necessary to ensure the level of bank reserves remained ample, he said. That's an important word, ample. Fed policymakers have been discussing how and when to end the temporary Treasury bill purchases, which have been underway since October, and what sort of permanent replacement it could use to ensure the central bank keeps control of the federal funds rate. Yields on US Treasury securities ground lower as Powell spoke, while benchmark US stock market indexes gave up most of their gains on the day. The dollar was largely flat against a basket of major trading partner currencies. In a related decision, the Fed raised the interest it pays banks for excess reserves by 5 basis points to 1.6%, a technical adjustment officials say was needed to keep the Fed funds rate around the middle of the target range. The interest rate decision was widely expected, with recent economic data showing the economy on track for continued growth, and no sign inflation is rising so fast that it poses a risk the Fed might need to counter with higher borrowing costs to slow the economy. Quote, "The vote was unanimous. That implies that the Fed is going to stay on hold here," unquote, said Peter Cardillo, chief market economist at Spartan Capital Securities in New York. Of course, they will always leave the door open. The Fed cut rates last year to bolster an economy buffeted by trade wars, and has set a high bar for any further rate changes. Powell has said a material reassessment of the economic outlook would be required for any shift. The Fed's assessment of household spending was marked down slightly from a strong pace in its December statement to a moderate pace. The Fed also noted that business fixed investment and exports remain weak. End of article. The situation to us is pretty clear. The fact that the Fed is unanimous in its decision, and we shall learn in a week or so the thoughts of the individual governors, does suggest that they're comfortable with both current rates and the $60 billion a month repo injection. This is not the sign of a worried Fed. That said, though, and there was a giveaway if one cared to look, Jerome Powell alluded to the fact that he was a little concerned that inflation was not closer to 2%, and that 2% was not to be regarded as a ceiling. Of everything that he said yesterday, this was the clearest sign that we should not rule out interest rate cuts later this year, something the Fed suggested wouldn't happen in its December statement. We've previously stated that we would expect one cut this year with the possibility of two, but we were confident of one. That said, the coronavirus could change the economic landscape if its spread cannot at least be restricted or in some way contained. More deaths have been reported today, and this is just the start of the contagion, and we have seen gold and silver prices strengthen on the back of it. We shall cover more of this in a later video. Now, Q4 GDP figures announced today were better than expected at 2.1%, the same as Q3, and against an expectation of 1.8%. And weekly jobless claims were also down 7,000 from last week at 216,000. Also across the pond in the UK, the Governor of the Bank of England has announced that UK interest rates will remain unchanged at its current 0.75%. Mark Carney, the outgoing governor, announced that the Monetary Policy Committee, the UK's equivalent to the FOMC, voted 7-2 to keep rates unchanged on the grounds that recent weak economic data had led to speculation rates could be cut. But Mr. Carney said, quote, "The most recent signs are that global growth has stabilised," unquote. Clearly, they wish to see also the after effects of Brexit during the coming weeks and months. So even the British hierarchy are currently confident about global growth, even though there are a number of headwinds against it. So what does this all mean? Well, to be frank, if it were not for the coronavirus, gold would now be $1,500 pushing into the mid to late 1400s, and silver would be $17 heading towards 16. But that is not where we are. It certainly looks like the situation is not only worsening, but is doing so at a pace. More than 170 people have now been announced dead, and more than 8,100 cases have been confirmed in mainland China, with 5 people being contaminated so far in the United States. To date, the deaths have only occurred in China, despite the fact that 22 countries are now affected, and some 8,246 cases have been reported. The faster and higher these figures grow, rest assured gold and silver prices will grow with them, and equity markets will decline in proportion. This, more than the FOMC decision, will have a greater impact on equity markets and precious metal prices short term. With a cure or antidote being readily available some 12 months away according to scientists, the situation is clearly going to deteriorate. The question is, of course, where is the tipping point before panic sets in? We must also not forget that the effect on trade can be considerable, especially as other countries, such as even Russia, has now closed its borders to those travelling to it from China. They haven't closed their borders to Chinese goods, but they have to Chinese people. So in conclusion, that whilst economic growth has not declined anywhere near as many had feared, and the Fed was feeling somewhat confident, this virus could put paid to all that. And we should now expect to see over the next week or so quite likely $1,600 gold and silver back up into the mid to late $18 level. But we shall cover this again in a more in-depth and up-to-date video. Thank you for listening. If you haven't already done so, please subscribe to this channel and press the bell sign so that you're notified of our videos as and when they are published. Not forgetting to comment below and share your thoughts on the state of the economies, not only of your own country, but that of the world. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.